Hi everyone. In this video we will discuss on the third part of Chapter 1, Factors of International Banking Growth. When banks are planning to establish operation in foreign country, they must take into consideration on two sets of factors. First is the home country's growth prospects and its state of economic, political and legal development, openness and stability of its financial system, and second is the interaction with other internationally active banks, relates to the features of the host country that may give particular banks a competitive advantage. There are 19 factors either from the perspective of home or host countries contributing to the international banking growth. First is trade bloc agreement. Second, low marginal cost. Third, knowledge advantage. Fourth, information services. Fifth, prestige or reputation. Sixth, banking regulation. Seventh, multinational advantage. Eighth, transaction costs. Ninth, market needs. 10th, risk reduction. 11th, economic development. 12th, competitive market. 13th, government policies. 14th, technological changes or advances. 15th, growing diversity. 16th, economies of scale. 17th, conditions in host countries. 18th, comparative advantage. And lastly 19th, efficiency considerations. A trade bloc is a type of intergovernmental agreement, often part of a regional intergovernmental organization, where barriers to trade in the forms of tariffs and non-tariff barriers are reduced or eliminated among the participating countries. Restrictions to foreign bank entry gradually eased by bilateral or regional trade and investment agreements. Trade blocs will contribute towards growth because of benefits in terms of economies of scale, cost-effective or productive, and increase in demand. Example of a trade bloc is AFTA. AFTA stands for ASEAN Free Trade Area. This trade bloc is participated by ASEAN countries including Malaysia. The purpose of AFTA is to support local trade and manufacturing in all ASEAN countries, by giving the tax privilege of 0 to 5% for export and import activities among the participating countries. Under the low marginal cost, the marginal and marketing knowledge that has been developed at home can be used abroad with low marginal costs. SWOT analysis can be implemented to find out more strengths and opportunities in new places abroad, and from that, international bank can exercise the best way of reducing costs. The factor of knowledge advantage becomes a major driver of customer service, creativity and innovation, and revenue growth. Customer satisfaction can be maintained by engaging with the local partners through collaboration of skills and knowledge, as this will deliver better products and services. Hybrid products and services, which is the combination of two or more types of financial products, can be introduced to cater local and foreign markets. Furthermore, the ability of human capital also needs to be highlighted. This can be done by engaging with the training institutions in order to produce a pool talent of banking officers, who are able to solve problems pertaining on complex products and services. Under the information services factor, the local firms in a foreign market may be able to obtain information on trade and financial markets in the multinational bank's home nation, as compared to the foreign domestic banks. Information technology plays a vital role in the growth of organization. In order to maintain the bank's competitive edge, the technology infrastructure of international banks need to be upgraded. Technology advancement can give the benefits of extensive network, centralized service desk, comprehensive management information system, and mobile alert service. For the prestige or reputation factor, normally the large multinational banks will have high perceived prestige, liquidity and deposit safety, that can be used to attract clients abroad. On the other hand, reputation can be defined as what is generally said or believed about a person's or thing's character. Reputation has a social element. It is intangible and difficult to quantify, but it plays a crucial role in social, professional and commercial interactions. Reputation can be built through constant adherence to the standard of procedures, or through advertisement of particular qualities. Next factor of international banking growth is banking regulation. Banking regulation originates from two factors. First is from the microeconomic spheres over the ability of bank depositors to monitor the risk originating on the lending side, and second, micro and macroeconomics concerns over the stability of the banking system in the case of a bank crisis. In addition to statutory and administrative regulatory provision, the banking sector has been subject to practice informal regulation. The government uses its own discretion, outside formalized legislation, to influence banking sector operations. Multinational banks are often not subject to the same regulations as domestic banks, in which there are reduction in need to publish adequate financial information, lack of required deposit insurance and reserve requirements on foreign currency deposits, and absence of regional restrictions. For the multinational advantage factor, the ultimate goal is to generate more revenue and income for owners or investors. The primary advantage that multinational banks enjoy over the bank that limit their operations to smaller geographical regions is that they have a larger pool of potential customers and access to cheap labor. International banking that has a strong presence in one location might not be able to expand effectively within their own area, but by opening new locations in other countries allows them to tap into new and unsaturated markets. For instance, a multinational corporation can set up their operation in developing countries and sell products in developed countries. Next factor is transaction costs. By maintaining foreign branches and foreign currency balances, banks may reduce transaction costs and forex risk on currency conversion if government controls can be avoided. Multinational corporations are subject to higher taxes and have to pay higher insurance and transportation of goods from producers to customers. In order to minimize transaction costs, the firm prefers to locate their business near the larger market. For the joint venture kind of business, 5 kilometers radius from the bank location is considered ideal. For the market needs factor, it is important to create a customer experience that produces lifetime value in relationships. Thus, international banks need to be innovative and creative in products and services practices. It is also required for international banks to actively develop competent staff and support systems to deliver experiences that strengthen relationship loyalty. SWOT analysis could be the critical information in order to expand client relationships and enhance tenure. International banks need to develop the SWOT analysis to gain competitive advantage over their competitors. In addition, market segmentation is crucial. International banks need to identify and highlight the strengths that they have, and increase efficiency in delivering the particular products and services. Employees should be encouraged to continually inform, educate and provide solutions to customers. Educating consumers is a critical trust building within the bank's strategic sales, service, and marketing framework. For the risk reduction, any corporations that do business abroad are always exposed to risk, for example risk of unexpected changes in economics, social, or political environment in the country that they are operating in. All of these risks can cause problems to their service. However, greater stability of earnings is possible with international diversification. By offsetting business and monetary policy cycles across nations, it can reduce the country-specific risk of any one nation. For the economic development factor, the profit-maximizing strategy behind the bank's international activities is affected by economic developments and regulatory environment in the home country. In the case of developing countries, the economic environment must take into consideration the needs of poor groups. Self-help that is supplemented with mutual help can be a powerful medium for the poor's effort to socio-economic upward transition. The poor or needy need to be given an equal chance for saving and loan or financing. The availability of financial and equality of opportunities to access to the financial services for all groups of people is known as financial inclusion. Under the economic development, the mismatch between the poor's expectation and capabilities of formal banking system need to be minimized. Under the competitive market factor, there is an increased competition among banks, development financial institutions, capital market, money market, and foreign exchange in related to the financial system development. The increase of competition has put pressure on profit margins at home country, which has encouraged banks to expand their customer bases abroad, and this situation has stimulates financial creativity and innovation. The rise of securitization has strengthened the bank's international expansion. It enabled banks to expand their financing options and allow them to match more closely the specific needs of different investors. Next factor for international banking growth is the government policies. Government policies can act as either a push or pull factor for international banking. Push factor is the situation or conditions that makes banks want to leave a place or escape from a particular market or country. Examples of push factors are natural disasters, political revolutions, and civil war. Meanwhile, pull factors are the positive factors that attract banks to new markets from other markets previously. A booming economic development market is a pull factor because banks can expand their operation and generate higher revenue from that situation. Push or pull factor might occur through the changes in regulation that results in increase of competition among domestic and foreign banking, or through the certain banking restrictions in the home country, which bank will try to avoid by redirecting part of their business abroad.